Hello and welcome to Personal Finance Times Weekly Update. This is your rundown of the biggest personal finance, economic, and market news from the week of August 4th through 10th, 2025. It's been a busy week. We saw a wobble in the stock market as new tariffs and a surprisingly weak jobs report spooked investors, Americans' credit card debt climbing to record levels, some hopeful signs on inflation, but with a catch, and major changes on the policy front, including student loan shakeups and new tax cuts. We'll break down what all this means for your money. The tone today is informative but conversational, so imagine we're chatting over coffee about the economy. Let's dive in. Credit card debt hits a new high. American households are deeper in credit card debt than ever. In fact, total credit card balances have swelled to about $1.21 trillion as of the second quarter of 2025. That's up from $1.18 trillion in Q1 and slightly below the all-time peak set late last year. Why so high? Inflation and rising prices are part of the story. Many folks have been relying on credit cards for everyday expenses and emergencies. In a recent survey, 45% of people carrying card debt said it's due to unexpected emergency costs or day-to-day necessities like groceries and utilities. It's a reminder that a lot of families are using plastic as a financial safety net. The cost of carrying a balance. If you have credit card debt, you're likely feeling the pinch from high interest rates. Right now, the average credit card APR is over 20%, among the highest borrowing costs out there. That means carrying a balance month to month can snowball quickly. For example, a $5,000 balance at 20% interest, if you only make minimum payments, will accumulate hundreds of dollars in interest in no time. So, if you can, prioritize paying down that high interest debt. Even knocking out a small chunk can save you money on interest. As Bankrate's Ted Rossman put it, for millions of households, credit cards represent their highest cost debt by a wide margin. Savings rates and rainy funds. On a brighter note for savers, the flip side of those high interest rates is that savings accounts are finally yielding more. It's 2025 and, believe it or not, many banks are offering around 4-5% APY on high-yield savings accounts. Just a couple years ago you'd be lucky to get 0.5%, so this is a big change. If you have an emergency fund or any cash sitting in a plain old checking account, consider moving it to a high-yield savings account to take advantage of these rates. Earning till the 4-5% won't make you rich, but it can at least help your savings keep pace with inflation. Are people saving enough? Despite higher savings yields, the reality is a lot of Americans aren't able to save much of their income. The personal saving rate, basically the percentage of disposable income that people save, is hovering around 4.5% as of June. To put that in perspective, before the pandemic it was common for Americans to save 10% of their income. In 2022, that rate fell to around 3% at times as people dipped into savings. So 4-5% is better than those lows, but it's still relatively low historically. This suggests many households are living pretty close to the financial edge, with not much room to stash money away. If you're in a position to save a bit more, even just automating an extra $20 a week to a savings account, now is a good time, because those higher interest rates are working in your favor. Every little bit helps to build that cushion. So, with debt up and savings still a challenge, what about our spending habits? Let's talk about how consumer behavior is shifting in this economic climate. Belt tightening begins. It looks like American consumers have started tightening their belts over the summer. Government data for May and June showed some surprising pullbacks in spending. In May 2025, consumer spending fell 0.1%. That was unexpected and marked the second monthly decline this year. What's going on? One factor is that earlier in the year, with talk of new tariffs, a lot of people and businesses rushed to buy big-ticket items, like cars and appliances, before prices could rise. By May, that rush had faded, so purchases of goods dropped off. In fact, spending on long-lasting manufactured goods, think cars, appliances, electronics, fell about 1.8% in May. We also saw a dip in spending at gas pumps, partly because gas prices were a bit lower, and even at restaurants and hotels. It seems households are becoming more cautious with discretionary spending, the non-essentials. Signs of frugal behavior. Even the service sector, which had been strong, saw a sharp slowdown. Services spending in May was almost flat, plus 0.1%, the smallest gain since late 2020. That suggests people may have cut back on dining out, travel, and entertainment compared to earlier in the year. Consumer sentiment surveys back this up. In June, the University of Michigan Index of Consumer Sentiment was about 18% below its peak from last December, indicating people are less optimistic and more wary about the future. The survey noted that consumers' views are still broadly consistent with an economic slowdown, and even expectations of slightly higher inflation ahead. In plain English, many folks are nervous, whether it's about prices rising or about the economy's direction, and that psychology is reflected in more careful spending. A mixed June. Now, June did show a bit of a rebound. consumer spending ticked up plus 0.3% in June, according to the Bureau of Economic Analysis. So we're not in a free fall, rather, it's an up and down pattern with an overall cooling trend. Households spend a touch more in June on things like housing, utilities, and healthcare, which could be necessities that you can't put off for long. But the big picture is that consumption growth has slowed. In the entire April to June quarter, Q2, consumer spending grew at only a 1.4% annualized rate, the slowest pace since early 2020. We're a far cry from the stimulus-fueled spending boom of a couple years ago. So what does this mean? For one, a more cautious consumer can slow economic growth, since consumer spending is about 2/3 of the economy. We actually saw overall GDP growth in Q2 2025 come in at plus 3.0% annualized, but funnily enough that was boosted by a steep drop in imports, thanks to tariffs, rather than roaring consumer demand. If consumers continue to pull back or focus only on essentials, businesses may feel the pinch in their sales. On the positive side, though, this cooling off could help further ease inflation. Less demand might lead to slower price increases. It's a delicate balance, and it leads us right into our next topic: what's going on with inflation and interest rates. Inflation. Cooling but not cold. Inflation has been a big story for the past couple of years, and the latest data shows it's cooling, but not all the way down. As of June, the Consumer Price Index, CPI, was up about 2.7% year-over-year. That's actually not far from the Federal Reserve's 2% target, and it's much lower than the 6.9% rates we saw in 2022. However, 2.7% in June was a slight uptick from 2.4% in May, indicating price pressures haven't completely vanished. Core inflation, stripping out food and energy, is a bit higher than headline CPI, and one worry is that the new tariffs being imposed could push prices up later this year. In fact, business surveys and Fed officials have warned that tariffs might work their way into consumer prices over a few months. Federal Reserve Chair Jerome Powell noted that many companies tried to absorb the initial tariff costs, but as tariffs persist, those costs are likely to pass through to consumers in the form of higher prices. So don't be surprised if certain goods, especially imported ones, get more expensive towards the end of the year. Fed holds steady, for now. Given this backdrop, the Federal Reserve held an important meeting at the end of July. The result? They decided not to raise interest rates any further at that meeting, keeping the benchmark federal funds rate at 4.25% per cent 4.50%. This was widely expected. The Fed had already raised rates a lot from 2022 to mid-2024 to combat inflation, and by now they've been in a holding pattern. Interestingly, the vote wasn't unanimous. Out of 11 Fed officials, 2 actually voted against holding steady because they wanted an immediate rate cut of 0.25%. It's been nearly 5 years since we saw dissents like that. Those dissenters are essentially saying, we've probably tightened enough and maybe even too much, let's ease up a bit. But the majority, including Powell, opted to wait and see. Powell has emphasized a wait-and-see approach on any future rate cuts, stressing that they need more evidence that inflation is sustainably coming down and that the economy truly needs rate relief. The Fed's official statement highlighted that while inflation has moderated, it's still somewhat above target, and uncertainty about the economic outlook remains elevated. Tariff uncertainties were explicitly mentioned as a reason to be cautious. In short, the Fed doesn't want to declare victory over inflation too soon, especially with these new import duties potentially kicking prices up. They also acknowledged that economic growth had moderated in the first half of the year. All this suggests the Fed is done raising rates, barring some inflation surprise, but they're not quite ready to cut rates significantly either. Market expects cuts. Now, here's where it gets interesting. Right after that Fed meeting, investors slightly pared back their expectations of rate cuts this year, thinking the Fed would stay cautious. But then, boom, just 2 days later we got some very weak job market data, more on that soon, and suddenly the market sentiment flipped. Investors began betting that the Fed will cut rates sooner rather than later. In fact, as of this week, futures markets were implying about an 87% chance of a quarter-point rate cut in September, and possibly a total of 2-3 rate cuts by the end of 2025. That's a big change in outlook. It shows you how quickly the narrative can shift. 1 week we're talking about the Fed holding steady into next year, the next week people are talking about rate cuts on the table because the economy showed a crack. For everyday people, the prospect of Fed rate cuts is a double-edged sword. On one hand, if the Fed cuts rates, it could eventually mean lower interest rates on things like mortgages, car loans, or student loans, at least for new borrowing or variable rates. That'd be some relief for borrowers after a period of very high rates. On the other hand, the reason the Fed would cut is because the economy might be weakening, which is not great news for job security or investment portfolios. Also, if you're enjoying the high yields on savings accounts, rate cuts would likely start nudging those yields down. So it's a trade-off. We're in this unusual spot where good news for borrowing costs might come hand in hand with bad news about the economy's strength. Alright, speaking of bad news about the economy, let's unpack that jobs report that everyone's talking about, and how it ties into the broader economic picture. Jobs report shocker. The July jobs report came out this week and it was a bit of a shock. The US economy added only 73,000 jobs in July, far below expectations. Most economists had forecast around 100K or more. To put 73K in context, earlier this year we were seeing monthly gains of 150K plus, and last year monthly gains were often 230K. So this is a significant slowdown in hiring. But the plot thickens. The Labor Department also revised the previous 2 months' job numbers way down. May and June's combined job gains were adjusted lower by 258,000 jobs. They were originally reported much higher. Those revisions are huge. In fact, analysis by Charles Schwab noted that a 2-month revision of 258K is the largest downward revision in over a decade, aside from the crazy pandemic period. What that means is the job market was weakening in late spring more than we realized at the time. If you average out the last 3 months, May, June, July, job growth was only about 35,000 per month. That is a dramatic drop from earlier in the cycle and, historically, such a low 3-month average has often coincided with the start of a recession. We're not saying we're in a recession right now, but it does raise eyebrows. The unemployment rate in July ticked up to 4.2%, from 4.1% in June. That's still low by long-term standards, but it's the highest unemployment rate we've seen since perhaps late 2023. Importantly, some other details. The number of unemployed people rose by 221,000 to 7.2 million. And more of those unemployed are long-term unemployed, jobless for 27-plus weeks. That figure jumped by 179,000, meaning about 1.8 million people have been out of work for a long stretch. We also saw labor force participation dip slightly to 62.2%, indicating a small share of people working or looking for work. On the wage front, earnings are still growing moderately. Average hourly earnings were up about 3.9% year-over-year in July, and rose 0.3% from June, around a 12-cent increase to $36.44 average hourly pay. Wage growth around 4% is a bit above inflation, which is approximately 3% or so by CPI. So workers' real incomes are finally rising slightly after inflation or relief from the pay cuts, in real terms, that people felt when inflation outpaced raises in 2022. However, if the job market continues to soften, we might see wage growth slow down too in the coming months. Why it matters. A cooler job market has pros and cons. For job seekers or employees, it means it might become a bit harder to land a new job or negotiate big raises. We're already seeing fewer job openings, about 7.4 million job openings in June, down from 7.7 million in May. Hiring slowed, and some industries likely froze new positions given uncertainty. If you're in tech or manufacturing, you might especially sense the slowdown, as those sectors have been hit by both higher interest rates and tariff issues. On the positive side, if you're an employer struggling with labor shortages, this easing could make it a bit easier to find workers and reduce pressure to hike wages. And for the economy overall, as mentioned, a softer labor market can help ease inflation, fewer labor shortages and less wage-driven price pressure. That's actually what the Fed has been aiming for, to cool the job market without crashing it. It's a fine line. Right now, we might characterize the job market as transitioning from red-hot to lukewarm. It's not frozen, people are still getting hired, and 4.2% unemployment is still relatively low, but the trend is heading towards slack. This is why the Fed and investors reacted so strongly. It's a signal that the economy is losing momentum. In fact, as we discussed, the weak hiring numbers immediately bumped up expectations that the Fed will step in with rate cuts to give the economy a bit of juice. Lower interest rates could, for instance, spur more business investment or consumer borrowing to keep things going. One more data point. Despite the weak jobs report for July, the broader economy did have some bright spots earlier in Q2. GDP growth was plus 3.0% in Q2, helped largely by the trade technicality and consumer spending on services. Also, June data showed personal incomes rising and spending rising modestly. So we're not in an economic contraction right now, but the risk of one might be rising as we head into the fall if these trends continue. Keep an eye on weekly unemployment claims and business investment numbers for early warning signs. This week, initial unemployment claims remained low, approximately 218,000, so layoffs aren't surging yet. That's a good sign. Alright, with the economy sending mixed signals, slowing jobs, but still some growth, how did the stock market react? Spoiler, not great. Let's move to the markets and see what happened on Wall Street. Stocks take a tumble. This week was a rough ride for Wall Street. After an impressive streak of record highs in late July, the market hit a wall. The S&P 500 fell about 2.4% for the week ending August 8, giving up some of its recent gains. The Dow Jones Industrial Average dropped 2.9%, and the tech-heavy NASDAQ was down about 2.2%. In fact, last Friday, August 8th, the S&P 500 had its worst single-day performance since May. If you were watching your 401k or portfolio midweek, you might have noticed that dip. Trade jitters and growth fears. The 1-2 punch that knocked stocks down was tariffs and the weak jobs report. President Trump announced new tariffs on imports from several U.S. trading partners, described as hefty tariffs, on a range of countries, which immediately raised alarms about higher costs for companies and consumers. Investors hate uncertainty, and tariffs introduce a lot of it. They can squeeze profit margins if companies eat the cost, or raise prices if costs are passed to consumers, potentially hurting sales. So, that news alone put the market in a risk-off mood. Then, add the underwhelming July hiring numbers, which stoked fears that economic growth is slowing more sharply than anticipated. Slower growth can mean lower corporate earnings in the future. Together, these factors caused a mini sell-off as investors reassessed their rosy scenarios. One analyst described the mood swing well. Investors went from a risk-on mentality, chasing stocks higher, to suddenly moving from risk and seeking safer assets. This was evident in the bond market. Treasury yields plunged as money flowed into bonds. The 10-year Treasury yield fell to about 4.22%, the lowest level since the end of April. When bond yields drop like that, it usually means investors expect slower growth and possibly Fed rate cuts, which make older bonds with higher yields more valuable, hence prices up, yields down. We even saw oil prices climb earlier in the week. Crude oil rose approximately 3% on the week, although if the economy slows, oil could ease off again. Gold prices jumped as well, since gold is often a safety play. Earnings. Amazon's swoon, Apple's boom. Beyond the macro factors, earnings season is in full swing, and a couple of big-name companies had outsized effects on the market. The poster child this week was Amazon, AMZN. Amazon actually reported strong overall Q2 results. Sales and profits were up nicely, but investors honed in on a weak spot. Growth in Amazon's cloud division, AWS, slowed down more than expected. Oz grew slower than rivals like Microsoft's Azure and Google Cloud. Since AWS is a huge profit driver for Amazon, that spooked investors. Amazon's stock plunged 8.3% in one day after the earnings report, and because Amazon is such a large component of indices, it dragged the S&P 500 and NASDAQ down with it. In fact, AMZN was the biggest drag on all three major indexes on that day. So, one company's stumble can really move the needle. That's the power of these tech giants. On the flip side, Apple, AAPL, had some good news. Apple announced its fiscal Q3, April to June, earnings, and it posted a record June quarter revenue of $94 billion, up about 10% from a year ago. iPhone sales and services revenue were particularly strong, hitting all-time highs for a June quarter. Apple's profit was $23.4 billion for the quarter, not too shabby. The market reaction to Apple was positive. The stock actually ticked up after the report. Apple shares rose a couple percent in after-hours trading following earnings. However, Apple's strong results weren't enough to lift the entire market sentiment given the broader worries. Many other companies also reported this week. About a quarter of the S&P 500's market cap was reporting results. Overall, earnings have been a mixed bag but generally okay. Analysts had expected roughly 4 to 5% year-over-year earnings growth for S&P 500 companies, and so far results are coming in around that range or a bit better, especially for tech. But corporate outlooks are cautious. CEOs on conference calls are talking about everything from higher input costs, tariffs again, to consumers becoming more price-sensitive. Market outlook. With stocks near record highs at the start of the week and then pulling back, a lot of investors are wondering, is this the start of a bigger correction or just a blip? It will likely depend on how the next data points come in, especially inflation numbers due next week and any developments on the trade front. If inflation stays tame and the Fed indeed cuts rates this fall, that could give stocks a boost. All else equal, lower rates often support equities. But if the economy continues to lose steam or if the trade war escalates further, we could see continued volatility or downside. For the long-term investor, the usual advice applies. Stay diversified and don't try to time these short-term moves. This week was a reminder that markets can turn on a dime based on headlines. After a strong run earlier in the summer, some volatility is normal. Use it as an opportunity to review your portfolio risk. Make sure you're comfortable with the ups and downs we're seeing. Now, beyond the markets, there were also some major policy changes making news that could directly impact your personal finances, namely tax cuts and student loans. Let's finish with a roundup of those. New tax cuts for 2025 and beyond. Big news out of Washington. Congress has passed a new tax and spending law, sometimes dubbed the mega bill, that includes fresh tax cuts extending beyond 2025. Remember the 2017 Tax Cuts and Jobs Act provisions that were set to expire in 2025? Well, this new law essentially extends many of those tax cuts. For individuals, that likely means current income tax rates, which were lowered in 2017, will not jump back up next year as previously scheduled. In fact, some taxpayers might see additional tweaks that could reduce their tax bills in 2025. The law also introduced various incentives, like an expansion of tax credits. For example, there's talk of new or extended credits for education savings and a continuation of lower capital gains rates. On the business side, corporate tax benefits are also extended, which supporters argue will boost investment and growth. However, these tax cuts come at a cost. To avoid blowing up the deficit too much, the law also features spending cuts in certain areas and the elimination of some programs. It's been noted that there were drastic cuts to critical supports and programs that help families, all to help fund these tax reductions. For instance, the law makes significant cuts to federal benefits like Medicaid and other welfare programs. Essentially, the philosophy was to trade some government spending, often on social safety nets, for letting people keep more of their own money via tax relief. It's a pretty ideological shift and has been controversial. Critics say it favors wealthy individuals and businesses. One advocacy group said it funds tax cuts for the president's billionaire buddies, while supporters say it will stimulate the economy and give families more disposable income. For the average person, the immediate takeaway is, your tax rates are likely staying lower than they would have been otherwise in coming years. So that's some certainty for financial planning, fewer worries about a sudden tax hike in 2026. If you're doing long-term planning, the extension of those tax cuts, like the lower brackets, higher standard deduction, child tax credit provisions, etc., is something to factor in. Of course, always consult a tax professional for specifics, but broadly, tax policy will remain more 2017 TCJA-like for the foreseeable future. Student loan overhaul. Perhaps even more directly impactful for many viewers is the set of student loan changes in this new law. This was a major part of the legislation, aimed at reforming higher education financing. Here's the rundown. Repayment plans revamped. The law terminates all current federal student loan repayment plans for new loans disbursed on or after July 1, 2026. That means the familiar alphabet soup of plans, Pay, IBR, the new Save plan that was just rolling out, etc., will not be options for students who take out loans in the future. Instead, there will be just two plans for those future borrowers, a standard 10-year fixed payment plan, and a single income-based repayment plan called the Repayment Assistance Plan, RAP. According to the law's text, RAP will function somewhat like current income-driven plans but with less generous terms. Notably, RAP will only forgive any remaining loan balance after 30 years of payments, versus 20 or 25 years in current plans, and it may have a higher payment cap relative to income. So, new borrowers might have to pay a larger percentage of their income and for a longer time to get relief. For many, that could mean paying more over the life of the loan. Graduate and parent loan limits. The law also makes big changes to how much students and parents can borrow. It eliminates the Grad Plus loan program after July 1, 2026. Grad Plus loans currently let grad students borrow up to the full cost of attendance, often tens of thousands per year. That will be gone for new students. In its place, there will be caps on graduate borrowing. Grad students will be limited to borrowing $20,500 per year and $100,000 total in federal loans for their graduate degrees, and professional students like those in med school or law may have a higher cap, around $50,000 per year up to $200,000 total. This is a huge change. It means students may no longer finance pricey grad programs entirely with federal loans. They might need scholarships, family help, or private loans above those caps. Similarly, for parents, the Parent Plus loans will now have a lifetime cap of $65,000 per family. Currently, Parent Plus also had no fixed cap, aside from cost of attendance. Capping it at $65,000 means families will have to find other ways to cover college costs if tuition is very high. Advocates of these caps say it could pressure colleges to slow tuition hikes and prevent families from taking on unmanageable debt. But critics worry it could shut lower-income students out of expensive programs or funnel them into private loans with higher interest. Goodbye deferments. Another change, the law eliminates certain deferment options for future loans. Specifically, economic hardship and unemployment deferments will not be available for loans disbursed after July 1, 2027. Under current rules, if you're out of work or earning very little, you can pause federal loan payments temporarily via deferment or forbearance. The new policy says future borrowers won't have that safety valve, at least not automatically. They'd presumably have to immediately enroll in the income-based plan, RAP, and pay whatever percentage of their meager income is required, even if they're unemployed. This is intended to prevent people from just postponing payments, but it could be tough on someone who loses their job and can't hit pause on loans. As one policy expert put it, this change could shred the student loan safety net, pushing more people into tough situations. These student loan provisions have stirred a lot of debate. Supporters, including the Secretary of Education in this administration, Linda McMahon, applaud the simplification. They argue the old system was overly complex with too many plans, and that limiting borrowing could help curb rising tuition costs by forcing schools to control prices. They also claim it will reduce taxpayer exposure for loan forgiveness down the line. Critics, however, say this is a huge step backward for college affordability and borrower protection. Organizations like the Student Borrower Protection Center call it a crushing blow that will make college debt more burdensome and push students towards private loans. They worry it especially harms low-income and minority students. For example, women, and particularly black women, carry a disproportionate share of student debt, and capping loans or removing income-sensitive benefits could make it even harder for them to pursue higher degrees and eventually build wealth. One more wrinkle: legal challenges. The Department of Education has acknowledged that parts of these reforms, especially the new repayment plan, are already facing lawsuits. Implementation could be delayed or altered depending on how those shake out. So, stay tuned. It's possible not everything in this law will happen exactly as written if courts step in. For current student loan borrowers, the good news is your existing loans and repayment plans are grandfathered. If you have federal loans now or take some out before mid-2026, you will still have access to the current repayment options, like Save or Pay, for those loans. The changes mainly affect future borrowing. But it's something to keep in mind if you were planning, say, to go to grad school in a few years. You might want to borrow any needed federal loans before July 2026 if possible, to still get on the old plans. And if you have kids in high school, these new limits mean you may want to start aggressively saving for college, through 529 plans or other means, because the government loans won't cover as much as they used to. Phew, that's a lot of policy change in one go. Big picture. Tax breaks are coming, but with cuts to public programs, student loans are being redesigned in a way that shifts more responsibility onto individuals. It's a reminder that elections have consequences. This is a result of the political shifts in Washington, and it's reshaping personal finance decisions for millions. That was a jam-packed week of personal finance news, and if you're still with me, kudos. You're now up to speed on everything from your credit cards to the Fed to your student loans. The takeaway this week is that the economic landscape is changing. Inflation is cooler but not completely tame. The Fed is on hold but might pivot to cuts if needed. The job market is showing cracks, and the government is enacting policies that will affect our wallets for years to come, from tax rates to how we pay for college. Through it all, remember that your personal financial plan may need adjusting. Maybe you build an extra buffer in your budget, take advantage of high savings yields while they last, pay down expensive debt, or reevaluate education plans under the new rules. Knowledge is power here. If you found this update useful, please give this video a thumbs up and subscribe to our channel. We do these weekly wrap-ups to help you stay informed and make smart money decisions. Drop a comment if you have any questions or if there's a topic you want to hear more about. And don't forget to visit personalfinancetime.com for more details on these stories. We have in-depth articles about the personal finance and more, the Fed's latest stance, tips for managing credit card debt, and a breakdown of the new student loan rules, all there on the site. Thank you so much for watching. Stay tuned for more insights next week, and until then, take care of your finances and each other. See you next time.